Unless the government bailed them out, banks very well may have been in very big trouble if it was not for this tax code. Which, by the way, restricted some of your retirement options to save the banks, which borrow your money at 1% and make about 5%, 5 times the money, so that they can profit. Nice. TAMRA of 1988, also known as the Technical and Miscellaneous Revenue Act, came as a follow-up to TEFRA and DEFRA. What those two did is defined what a life insurance contract is, and also the minimum amount of insurance you need for a given amount of money that you put in based on your age, gender, health, etc. Here's what you could have done, and this is what was being done at larger and larger scale and making banks, well, nervous. You have $1 million in a bank, and let's say based on your age, gender, and health that you need about 1.1 million in insurance if you're going to put that into, for example, an indexed universal life policy. So you did that. Access to tax-free if you want, grows tax-free, transfers tax-free, and has competitive market-like returns. So people were doing that. Now, if you did that before 1988 in TAMRA, you were grandfathered in and kind of hit a little jackpot there. Not only were people doing this at large scale, the banks were doing this at large scale with your money, right? That's how banks work. People give them money. They pay you 1%, for example, on a savings account, and they go and loan it out to other people or put it in investments or have their tier 1 assets that earn more than 1%, hence they profit. Problem is, if this were the case, why would anyone put money in a bank? I certainly wouldn't. The banks realized this and basically said, hey, I know we're doing this too, but we can't really compete. Everyone's gonna move our money from us to the insurance companies. This needs to be slowed. Keyword, slowed, not eliminated. They were doing this as well. Sure, the government was aware of this. They enjoy people putting money away, saving it, and using their hard-earned money to pay for their retirement, as opposed to sending them checks for their unemployment. So TAMRA is born. It's a 471-page document. It is the third and final major or most cited tax citation when it comes to using, for example, life insurance for tax-free retirement or tax-free income. While everything else stays the same in terms of guideline single premium, guideline level premium, what's considered gross income, what changes is how fast you can put the money in. Instead of putting $1 million in one day like that, TAMRA comes and adds what's called the 7-pay test. What this says is in any given year, across the course of those 7 years, this is the most that you can put in 1 year to get closer to getting in the full guideline single premium. For example, let's say your guideline single premium was $1 million. Before TAMRA, you could have just dumped that in on day one and boom, you hit your guideline single premium. You're never going to put money in the policy again, except in some rare cases, and you're done. What TAMRA does is it comes and says, hey, well, your 7-pay premium is actually $250,000. If that were the case, what that would mean for you is that you can only put $250,000 in a year over the course of 7 years until you hit your guideline single premium of $1 million. So in this case, in year 1, 2, 3, and 4, you would put in the $250,000. Then once you hit your total $1 million, you would not be funding the policy anymore. Even though I say 1, 2, 3, and 4 for the years, you're actually doing this in 3 years and 1 day. So the second you hit the first day of the 4th policy year, you can put that last, let's say, $250,000 in, and your policy is maximum funded. And naturally, things slowed down. People got impatient. They didn't want to wait 4 years, 5 years to put all their money in. They went with other vehicles. Banks could finally breathe. If you found any of this helpful and wonder, hey, what does this actually look like for minimizing taxes or increasing my own net spendable income in retirement? Click the link below. There's a free 20-minute consult with me to kind of break things down. I'm happy to do that. I will warn you though, it's not a traditional strategy. It's not stuffing money into an IRA and 401ks and holding forever until you die. You like to think a bit outside the box when it comes to making sure we keep you safe. Thank you.